Hello everyone, welcome to another day conversation with Professor Choi. Today we're going to be having a conversation. This is my fourth video on investing for beginners, and today we're going to talk a little bit about why do stocks increase in value over time. Now, the first thing you need to remember from other videos that I may have mentioned is that they don't have to. In other words, there's no such a thing as a 100% secure investment. You need to understand that investments have risk, and some have more risk than others. When we say the word risk, we mean that you could lose money, and when we say higher risk, it means that you could lose more of your money or you could lose all of your money. Now, stocks, like any other sort of investment, they don't have to gain in value. I've heard people say everything that goes up goes down, everything that goes down goes up. None of that is really true. This is not gravity, okay? So they don't really have to. Now, why do they tend to? Especially if you have a growing economy, a country that's growing over time, and that's really the key. So in the long run, the stock tends to reflect the value of the business. To understand this one, I want you to think about something that's happening in the year 2021. So in the year 2021, a company like Tesla is valued by the stock market at close to $800 billion, the company. But they don't sell that many cars, nor do they have that much revenue, compared to, say, a company like General Motors that is valued at something like $60 billion. Now, General Motors sells easily 10, 20 times more than Tesla. There are 10, 20 times more cars than Tesla. But Tesla is valued at 6 or 7 times more than the value of General Motors. Why is that? In other words, the stock seems to be reflecting a market value that is way higher than the actual company today. And the reason is simple. Is because stocks sometimes don't reflect the value of the company today. That's why there could be companies that are undervalued today and overvalued today. In other words, the current value of the company either is too optimistic or too pessimistic about the reality of that company. And that's where you come in, and you're able to basically pinpoint the correct path or the correct future path for this particular company. Now, in the long run, the value of the company tends to reflect the future of the company. In the short run though, and when we say short run, we mean smaller time period versus long run, which means in the future or sometime in the future, and it could be a really long time, or it could be a few years from now. But basically, in the short run, the stock can change up and down rapidly for many reasons. They don't have to follow any particular pattern. So this is what we like to explain all the time, that in the short run, the market and the behavior of stocks, it's really what we call a random walk. So on any day-to-day, it's very difficult to know why the stock went up or why the stock went down on any day-to-day, okay? Now in the long run, some of this stuff is easier to predict because it has to do with the fundamentals of the business. In other words, is the business growing or is the business shrinking or is the business stable, flat over time? Okay? So let's talk a little bit about that. Imagine that we have this stock of this company called Choi Inc. And Choi Inc. produces trinkets. Okay? Now, the path of the stock in the short run could be very volatile. It could go up and down. But if Choi Inc. is making money and growing over time, then you're going to see an upward path on the stock in general. So in other words, even though it's fluctuating up and down, you're going to see a general pattern of higher highs and higher lows on that stock behavior, on the price of the stock behavior. Now, why do you see that? Well, it has to do with the growth. In other words, is the revenue in the future expected to be higher than the revenue of the company right now? The costs. Are the costs expected to be lower in the future compared to that revenue? The growth in the business. In other words, how many customers are now purchasing that product versus how many customers are not purchasing that product. The profitability of the business. Remember, the word profit has to do with the difference between revenue, which is sales, minus cost of doing business. So you could have higher profitability with basically higher revenue or lower costs. Okay? And of course, like I said, the stock behavior over long periods of time, over the long run, reflects that profitability, reflects that revenue, it reflects that growth. And the market is a mechanism that tries to basically put a price on that growth. It tries to, let's call it, estimate the future. Of course, there has to be good ROI, good return on investment. In other words, when the company keeps some of that revenue to grow, are they doing the right thing? Are they setting themselves up for the right story? Are they setting themselves up for the right future? The stock market in general, and remember this is the difference between a particular stock versus the market. The stock market tends to reflect the value of the businesses in that market. If the businesses are healthy and growing, then the market will grow with those businesses. Okay? So this is, again, the most general kind of way of looking at this kind of stuff. Now, to understand this, let me give you a couple of basic examples of how these stories can change very rapidly. So, at this point, I guess you're going to find out my age, but basically, if you go back to my high school years, one of the things that we used to love to do when I was in high school is we used to love to go to Blockbuster. And Blockbuster, for those of you that are too young to remember, was basically a store where you could walk in and you could get DVDs or VHS cassette players to basically watch a movie in your house. We didn't have streaming. Okay? So this is a time where internet speed was slow. And most people basically had cable. But cable at the time did not allow you to stream whatever you wanted. In other words, you had some kind of stream coming in and you had to watch whatever was in it. You could flip channels, but you couldn't change whatever was on the channel. So there was no video on demand at the time, all right? Because internet speeds were very slow. Blockbuster was thriving. So they had stores all over the United States. Every time you went over there, you could get popcorn if you wanted, or you could get some candy to go with that movie that you were going to be renting, and so on and so forth. And at the time, the people who used to basically work for Blockbuster thought, well, you know, I could be here basically forever. What changed? Well, at some point, internet speed started increasing. And a new company showed up called Netflix. In case you don't remember, Netflix started as a competition for Blockbuster on the same thing. Netflix started by sending people DVDs and VHS cassette players, mostly DVDs, to your house. In other words, it was a mail video delivery service. So instead of you going to a store, physically going to a store and grabbing that DVD that you wanted to watch, or grabbing that cassette player, that VHS cassette player you wanted to watch, you would basically just order it on a website. So you had some kind of online website where you could go in and say, well, I want to order this, I want to order this, I want to order this, and then they'll send to you as a sort of subscription service for people who wanted to get DVDs regular to the house. Yes, that's how they started. But at some point, Netflix started growing into the new market. That new market was basically the fact that now people were able to stream things into their house because internet speeds were growing very rapidly all over the world. Blockbuster failed to see this coming. So of course, at some point when people thought, well, the stock is going to continue to grow forever, at some point when the business model changed, the company stock declined rapidly to reflect that, and eventually it just went bust. It went bankrupt. Now, which stock benefited from the decline of Blockbuster? Netflix. Alright? This is kind of like how it goes again. So this is the whole idea. As long as the future of the company is bright and good, you're going to see that stock increase. When that story changes, then you're going to see the stock decline. In the short run, there might be periods of up and down. But I want you to think about general up and down going down, or general up and down going up, or general up and down flat. So if the company is not growing, if the company is not expanding, etc., it will be flat. If the company is shrinking and the business model is changing and there's some kind of secular change in trend on the behavior of those consumers on the downward direction, then you're going to see that stock going down. That explains, of course, things like the future of automobiles, which a lot of people think is the Tesla model. Okay? All these other companies, though, they could easily catch up, just like Netflix did to Blockbuster. All right. Warren Buffett. If you don't know who Warren Buffett is, by the way, you really need to Google it. He's one of the richest people in the world. And he made most of his money by basically just investing in things like stocks and bonds. And of course, in companies. I like the Warren Buffett way of thinking about things. Now, according to him and the majority of seasoned financial advisors, the best way to invest safely is to basically buy a low-cost exchange-traded fund or fund that follows the performance of the market. In other words, if you see an economy that is growing, and again, this doesn't even have to be in your own country, but if you see an economy that is growing, if you see something that has a good future, a country that has a good future, a lot of the times you don't really need to even invest on an individual company. You can just buy the entire market. The market reflects the economy of that country. So if you have a growing economy over time, then you could buy something that reflects all the economy and then basically just go with the flow. It's really the easiest, lowest paying way to invest. You don't have to follow it regularly. You don't have to look at it every day. What you basically do is you grab savings and you buy some of these nice and slow over long periods of time. 5 years, 10 years, 15 years, 20 years. Okay? The market is not the economy. A lot of people tend to see the stock market and say, well, the stock market is doing well, the economy must be doing well. Not really. As I mentioned, stocks and the market reflect the future of the company. It does not reflect what's happening right now. So in other words, right now it could be terrible, the economy, but the market might reflect something higher or lower than that. So the market is not the economy, but it tends to reflect the expectations of where the economy is headed. And thus, that's why stocks tend to increase in value over time, especially in countries like the US lately and in China. We have stock markets all over the world. And most people who are going to be watching my video are in the United States. But I need you to understand that basically stocks are companies. And this behavior of a stock reflects the underlying value of that company in the long run. In the short run, you could have a lot of very crazy behavior because of the way the market is structured, because of maybe lack of liquidity. All right? But the point is, if you look at it and stretch it for the future, that stock will reflect the future of the company. So if the future of the company is bright, you're going to see that stock go up over time. If the future of that company is bad, then you're gonna see that stock go down over time. And if that company is not growing and it's sort of standing, you're gonna see it go sideways over time. All right? Well, this is Professor Choi. Have a good one. Thank you for watching my videos.